folks, we will now jump on to the data and assumptions bit, and I'll request my colleague Vijitra to take the next two sections.
Thank you, Khushwant. We'll now be going into data and assumptions. We'll first start with key data requirements. For ease, we have highlighted here specifically requirements that are needed for estimating fair value of option, which, as you recall, was the first step in ESOP valuation. And then the data, which is specifically required from an expense recognition and disclosure perspective. When we determine fair value of option, the granularity at which data is required is typically grant level. So employee level data may not necessarily be needed at this stage. Fair value of option, like Khushwant spoke earlier, typically requires ensuring we are capturing attributes related to grant. So this includes the date at which the grant was made. Everything in this accounting standard, especially for ESOP, is mapped to grant date. So that is the first input. You do require share price at the date of grant, again, to be able to estimate the fair value of the option. You also require other attributes, exercise price for each of the grants made, vesting schedule. If there are market-linked vesting conditions, then that is required to be maintained from a data perspective. And then overall exercise period and expiry period. When we look at expense recognition and associated disclosure, the data is required at an employee level. And specifically for each grant given to every employee. So employee level and at a unique grant level. Here the data needs to be maintained at all levels, that is the units that are granted, units vested, unvested when they lapsed, the date. The vested unit lapsed, that needs to be maintained separately because it is allowed for separately in your expense recognition. It doesn't go through P&L reversal, it goes through a balance sheet adjustment. It's also important that you are able to record the reason that someone exited. Why? Because there are certain cases in the form of death or disability, or in case of listed companies, in case there is retirement and unvested options are there. The law requires, to kind of keep recognizing the cost for those. So in death and disability, and immediate vesting is to be considered for anything that has not vested to the individual. And therefore, giving this information to your valuer becomes important. Whilst in case of a listed organization, in case of retirement, the unvested options are obligated to continue to vest as per the original vesting schedule. Similarly, the non-market vesting conditions become part of our expense recognition rather than fair value of options, and they need to therefore be maintained separately. And the last thing being the units which have been exercised, they need to therefore be adjusted within the balance sheet. Apart from this, we often come across a lot of transactions that keep happening, especially in the private space, where companies may either undertake a modification of grant. Lately, a lot of companies have been undertaking surrender of options by employees and subsequently settling them in cash. Further, companies, especially when they are going for IPO or even listed companies, often undertake bonus and splits. All of this impacts your ESOP accounting, and it may potentially impact both fair value of the option and expense recognition. Therefore, it is important that the data for these is maintained and supplied as part of ESOP valuation. Those are the key data requirements. With that, I will go into the key assumptions which influence your fair value of option. As Khushwant highlighted earlier, fair value of option entails setting 6 assumptions. There is share price at the date of grant. There's exercise price, expected term of option, expected volatility, expected dividends, and risk-free interest rate. From a materiality perspective, it is expected volatility and expected term of options which materially impact the overall fair value of option. Remember, higher their fair value, higher is the overall charge to your income statement. Thus, if any finance professional is looking at fair value of option, it's often or it's best to kind of understand how the expected volatility and expected term of the options has been set. We will accordingly be doing a deep dive into these two assumptions, and we will cover the remaining 4 assumptions at a broad level. Starting first with expected volatility. As the name itself suggests, expected volatility kind of measures the amount by which the share price of the company is expected to fluctuate. So how volatile is your share price? How volatile is it expected to be in the remaining term of the option? Expected volatility in a way directly influences the time value of option, that is how much in the money the option can be in future. As a general thumb rule, higher the expected volatility or assumed volatility, higher will be your P&L charge, and vice versa, lower the expected volatility, lower will be the P&L charge. If you look at the table here, we have just taken a simple example where we've assumed the share price and exercise price both to be equal to each other, 100 rupees. And we have varied the expected volatility from 20% at 5% intervals from 20 going up to 50%. And calculated the Black-Scholes option price as a consequence. If you see, whilst moving the volatility from 20% to 50%, the option price compared to the base has almost increased by 50%. That is the impact that your volatility assumption can have on your overall fair value and therefore on your expenses to be recognized on account of ESOP. I do want to highlight here that a recent study that we did of listed companies and their expected volatility assumption, we saw that across sectors, the median volatility assumption hovered around 40%. And therefore, that could be an indicator of the kind of volatility assumption that is feeding into ESOP valuation generally, and that could be leveraged a lot by private companies. Having given that background on why volatility assumption matters, it's important as practitioners to be aware of what is it that Ind AS 102 entails for us in setting volatility assumption and what are the practical considerations that we should be aware of. From a Ind AS 102 perspective, the key thing to note is that the standard requires the volatility assumption to be consistent with the market data available on the date of grant. This condition is applicable irrespective of whether you are a privately held company or listed company. What this means for privately held or unlisted companies, or for that matter, even companies which have only got listed relatively recently, is that your volatility assumption needs to be set taking into account actual historical volatility or implied volatility of other listed companies which are comparable to yours. And if no comparables exist, then of similar sector companies. The other thing to remember is that your volatility assumption needs to be consistent with the expected term of option. This then becomes important for listed companies where expected term of option is typically set differently for each of the tranche that is vesting. From a practical consideration perspective, the impact for listed companies, the volatility assumption is first set taking into account the actual volatility seen in their own data, own share price data over the period of the option. Key thing to note is if you have options that are, say, vesting at the end of some portion vesting at the end of year 1, year 2, year 3, you would ideally be setting a different volatility assumption for the tranche that is vesting at the end of year 1, for the tranche that is vesting at the end of year 2, and subsequently for the tranche that is vesting at the end of year 3. In case of privately held companies, the key challenge that comes is in being able to find the right comparable companies to consider for volatility purposes. And this becomes quite important actually, because if you don't consider right set of companies, you may significantly overestimate or underestimate your volatility assumption. A big challenge that we see is that there are a lot of companies which, as we call, are the new age companies, and no direct comparables are existent on the listed space. And to that extent, a lot of judgment goes in finding companies which may be in similar industry, listed in India or outside, can be compared in terms of market cap or general business models. The bottom line does remain that we still need to have observable market data to be able to set volatility assumptions, irrespective of whether you are a listed or an unlisted organization. The final volatility assumption is typically adjusted and mostly adjusted upwards than downwards for illiquidity considerations if we are talking about a private company versus a listed company. Adjusted for the business model where a comparable data set may not be available, and this adjustment could work both upward or downward. And then adjusted for impacts which we don't think will repeat themselves in future, such as COVID, but which are present in the historical data we are using for analysis. That's the key requirements and considerations from a volatility perspective. Having covered volatility, I would move to the second key assumption, which is expected term of option. Expected term of option from a ESOP valuation perspective typically refers to the time from the grant date till the date you expect the options to be exercised. When we say period from grant date till the period the options are expected to be exercised, we in a way obviously include the vesting period, because the options cannot be exercised until they are vested. And it's common to include a period after vesting to allow for the fact that someone has 3 years, 4 years, 5 years post vesting available to them to choose when they would like to exercise their options. Similar to volatility assumption, expected term of option is again a material assumption. In fact, used in conjunction with a high volatility assumption, a higher expected term of option will result in a higher fair value and therefore a higher charge to P&L on account of ESOP. Again, we've illustrated the point here with the same example we saw a couple of minutes before under expected volatility. We took the same example, but just varied the expected term for 4 years to 8 years and kept the volatility at a median assumption of 40%. Again, if you see with the volatility being 40% and the expected term increasing from 4 years to 8 years, your overall option price can increase by almost 38% compared to the base case scenario. So both of these assumptions put together can influence materially the overall option price and therefore directly impact the level of cost that you book on account of ESOPs. Again, going from similar to how we did a deep dive on expected volatility assumption, going into how expected term of option is set. Here, from an Ind AS 102 perspective, it's essential to note that the standard is not prescriptive on how do you set expected term of option. Instead, the standard suggests that you need to consider all factors which can impact the expected term of these options. So obviously, like we discussed, your vesting period is the key. Unless options are vested, they cannot be exercised. So the standard does require us to consider vesting period and associated exercise period. The standard also does require us to consider aspects like share price level, volatility, and past trends of the company in terms of assessing when have people on average exercised their options. That is what the standard generally requires. But to put it down as a framework that could potentially be leveraged by listed and unlisted companies. From a listed company perspective, typically what happens is the ESOP scheme is very clear. It says that once the options are vested, you have, say, 5 years from the date of vesting to exercise your options. What that also means is that if you have given a grant which has, say, a 3-year vesting schedule with 33% vesting at end of year 1, 33 at end of year 2, and remaining at the end of year 3, each of these vesting dates will have a different period by which their endpoint can be exercised. So the options vesting at the end of year 1 can be exercised in a 5-year period from that date. Options vesting at the end of year 2 can be exercised in a 5-year period from the end of year 2 date, and same way for year 3. To be able to factor or incorporate this aspect perfectly, what we suggest is that for listed companies, the options should be determined at a tranche level. Tranche level means that the options vesting at the end of year 1, their expected term of option will be 1 year of vesting plus the 5 years available for exercise window, and taking an average of that. So 1 plus 5 is 6, and so an average would be, or by 2 would be 3 years. That would become my expected term of options vesting at the end of year 1. The same philosophy will apply for options vesting at the end of year 2 and year 3 in case of listed company. As a result, we would have a separate option price for all the tranches that are vesting. The companies therefore have an option that they can kind of report separate option price for each tranche, or for brevity, they could find an overall weighted average option price and use that in their analysis. Please remember that in case there are any market-linked vesting conditions which are there already incorporated in fair value of option, the expected term of option that you set needs to be consistent with what you have assumed in your overall assessment of these market-linked vesting conditions. The framework actually changes materially when we look at unlisted companies. The reason is that a lot of unlisted companies, the exercise window is not a fixed time period. It's instead linked to happening of certain corporate transactions for the company, whether it's in the form of listing, strategic sale, buyback, or any other such event. Therefore, it is kind of difficult to set an expected term of option using the formula approach that can be taken for listed companies. In unlisted companies, as a consequence, management input is key on when they expect such events to happen. And then that is factored into option price. Typically, because all the options vesting in different tranches are going to get exercised at one shot if a big liquidity event is going to happen for the company, it's common in the private company space to have a single option price for each grant versus a listed company where option price is set separately for each tranche of vesting. So that's how the expected term of option works both in case of a listed company and unlisted company. Having covered two material assumptions that we spoke about, volatility and expected term of option, we will also look at how some of the other assumptions work, how they are required to be set, and what is their impact on the fair value and P&L charge. Share price and exercise price are typically looked at together because the difference between the share price on the date of grant and the exercise price reflects the discount that is being given to the employee, or as we call it, the intrinsic value. Now, obviously, in terms of setting the assumption, exercise price is a given input. In case of share price for listed companies, it's available. The closing share price is taken from the stock exchange with the highest trading volume. However, in case of unlisted companies, the share price to be used here again needs to be consistent with the share price that you may have seen in past shareholding transactions, any valuation reports available internally. And in case nothing is available, then ideally studying the valuation multiples of comparable companies and finding out the share price of the private company in question. Key thing to note is a lot of private companies sometimes feel that they should just use book value, but the standard is quite clear that it needs to be a market value estimate and not a book value estimate. Once you have the share price and the relative exercise price, the difference between the two, the intrinsic value of the option, will determine how your option price will move and how the fair value of the option or the corresponding charge to P&L will get impacted. Higher the intrinsic value, which means higher discount that you are putting on the table, all else being the same, there will be a higher fair value of option and a higher charge to your P&L. Vice versa, the lower discount that you put on the table, the lower, or keep it equal to share price, lower will be the fair value of option and therefore lower charge to P&L. The second assumption is expected dividend. This specifically in case of listed companies is relatively an important assumption, and it can change the direction in which your fair value of option is moving. As such, dividend just represents your dividend yield. It's typically set taking into account the actual dividends that you have paid in the past. And of course, adjustments are made for any changes that the management expects may happen over the remaining term of the option. Private companies can also factor this input if they are dividend paying companies or they become dividend paying companies over the course of term of the option. Interestingly, in case of dividend yield, higher the expected dividend, lower is the fair value of option and therefore lower is the charge to P&L. This is basically because these dividends in case of ESOPs are not available to the employees unless they actually hold the shares of the company, and therefore higher the dividend that the company pays out during this period, lower is the cost of these options or the potential value of these options for the employee. Therefore, you see a reverse angle here. Higher the dividend yield, lower is the fair value when charged, and vice versa. The third assumption is the risk-free rate of interest, which a lot of people are already familiar with from other employee compensation benefits that we value. This theoretically represents the yield on zero coupon bonds, which are considered risk-free. In India, because zero coupon bonds are not available, it's common to take an annualized yield on the government bonds of appropriate duration. Duration here is always the expected term of the option. Risk-free rate is relatively an immaterial assumption when it comes to option pricing, and a change in this assumption does not materially move your numbers. But yes, theoretically, a higher risk-free interest rate typically results in a higher option value and a higher charge to P&L, and vice versa, a lower risk-free rate results in a lower fair value of option and a lower charge to P&L. With that, we have effectively covered all the assumptions that go into option pricing. In terms of a recap, like we have discussed, expected volatility and expected term of the option are the ones which are extremely critical and sensitive to your option pricing. But yes, we need to get all those right.